Hello and welcome to Levin, Papantonio Securities and Business Tort Litigation segment. We appreciate the opportunity to spend some time with you today, walking you through our practice. My name is Peter Mouget. I would like to start off by introducing the newest member of our department, Erica Reed. And I'd like to spend a few minutes before we get started walking you through Erica's background, and we certainly are fortunate to have her here in Pensacola. Erica, why don't you start off just telling us where you're from originally?
Sure. Thank you for having me. My name is Erica Reed. I'm an attorney at Levin, Papantonio. I just moved to Pensacola from Washington, D.C., which is my hometown. Moved to New York for college and law school at Fordham University and then NYU Law. Prior to being an attorney, I have a background in the arts, actually, so this is my second career. I was a rockette at Radio City for 5 years. I worked my way through school as a performer.
And rockette, those are the Radio City Music Hall with the famous
right.
leg kicks.
The one and only.
That's cool.
The one and only rockette. So
That's
my background is in dance, and then I went on to law school, and I've been practicing for about 7 years. My background is in commercial litigation. I also did some antitrust and some patent work, and now I'm in the business torts group at Levin Papantonio. Our practice primarily focuses upon representing individuals and institutional investors who are seeking financial recovery from losses suffered due to securities fraud. We do some complex business litigation, in addition to what are known as whistleblower or qui tam litigation, where you have an individual that is complaining about a potential fraud against the government or a securities violation that his or her company has perpetrated.
Now, in addition to your undergrad and your law school, you also have a graduate degree as well, correct?
Yes, I have my master's in law and trade regulation.
Okay.
Which covered antitrust and intellectual property.
Now, when you say antitrust, explain a little bit about what antitrust is.
Antitrust deals with the laws that govern competition between companies and ensuring that a business does not engage in activities that prevent another business owner, small business or large business, from actively pursuing their endeavors in that particular business.
Another area you mentioned was kind of qui tam or whistleblower, and you said it was a fraud against the government. Would you explain a little bit more about what you mean?
Sure. For example, we get calls, we're getting numerous calls by individuals who have seen a red flag at their company, that think that there is some activity going on that their company is engaged in that is a violation of a law, that is a fraud perpetrated against the government, whether that be taxes, for example,
right.
And filing their tax return, or the company's tax returns being faulty or something like that.
How about here in the Panhandle, where we have a lot of defense contractors, a lot of Navy presence, and as far as like fraudulent billing, where bills for services that are not performed, similar to, does that fall under the whistleblower or qui tam?
That absolutely would fall under the whistleblower qui tam.
All right. Today we're here to focus primarily, though, on securities litigation, and even just a smaller niche of securities litigation. As Erica mentioned, the securities litigation falls into large kind of institutional cases where we represent pension funds, states, and then also we kind of call our mom and pop or our retail brokerage litigation, which is, let's just say, for instance, you're 40, 50, pushing retirement, 60 years old, or even into retirement, and you go in to your financial advisor to meet with them, sit down, and put together a portfolio, because of course you work for your whole life and 401ks and IRAs, and you save, so when you hit retirement, you have that money set aside and you put it to work together for you to generate income. So you can live off of that the rest of your life. And the point is taking that pot of money, hopefully, that you've saved and supplements with Social Security, and then you take that, invest it, and that return helps provide income while you're in retirement. But a lot of folks don't have the tools necessary to make decisions and understand what kind of risks are out there. And people sometimes ask us, I mean, you sue people just for losing money in the stock market. Everybody knows that you can lose money in the stock market. But Erica and I are going to take you through some slides that give you some tools, kind of elementary baseline, so you can have an understanding that whether it be any of the big brokerage firms, Merrill, Citigroup, or even the smaller ones, that they have a duty or an obligation to construct the portfolio, put it together, so it matches your investment needs. So Eric and I have got a handful of slides we're going to walk you through, some of which are a little bit hard to read.
That's right. So as Peter said, we're going to give you some of those tools that you need to invest your money smartly. This first slide we have is a pyramid that shows the layers of what's called diversification. Peter, why don't you first explain what diversification means before we go into the different layers of the pyramid?
Diversification, everybody's heard of the old adage, don't put all your eggs in one basket. You want to split everything out. And in the context of the stock market, diversification, just from its broadest level, means that you want to have your retirement corpus put into stocks, bonds, and cash. Just from and some people want to include real estate, but just you have different pieces spread out amongst all of those different baskets.
And on this pyramid, how is that reflected? I see that the bottom layer of the foundation of the pyramid is asset allocation, and then explain what each layer of that pyramid
Certainly
represents.
If you start here at the bottom, as you mentioned, it's asset allocation on the bottom, and that's spreading everything out to stocks, bonds, and cash. So that's the foundation of the pyramid, the foundation of the house. And then as you go up the pyramid, let's start now at the top, and we'll meet in the middle. It's broken out between stocks and bonds. So on the bond side, you want to have everything diversified or spread out between credit quality. So you have all the way from investment grade all the way down to kind of junk bonds or high yield bonds. It's important to have all different kinds. It's important to have different maturities, meaning you want to reduce the risk by having some bonds that are short-term, some bonds that are intermediate, and some bonds that are long-term. And then bond type. You want to spread your fixed income out between different sectors, and how bonds are constructed. Now, if you go over here on the stock side as well, you want different managers or different sectors. You want different industries. So, for instance, you want healthcare, you want oil, you want pharmaceuticals, you want all of your eggs spread out in all kinds of baskets. And then also very important, market cap, which just is a really kind of a fancy name for size. You want small, medium, and large companies because they all behave differently or move differently. And then style is simply what they call value and growth. So again, if you go back to the simplest form, all your eggs spread out, different kinds of bonds, different kinds of stocks, different industry sectors, and you want everything where it's all spread out. And the reason for that is because everything, and just to kind of put it in simple parlance, you want investments that zig when others are zagging, and it smooths out the portfolio and reduces the risk without sacrificing return, and we'll get into more of that later.
And talking about asset allocation and the different types of investments, let's give the viewers a little more detail about the terms that they would come across. For example, equities and stocks, which mean actual ownership of a specific company, and fixed income and bonds being another type. And then from there, the next level being high yield bonds or junk bonds. Can we walk through these two bullets that we have up on this slide and give a little more color to what these terms mean?
Absolutely. As you mentioned, equities mean that you have ownership. You have equity. You own a piece, whereas fixed income is a loan. You're actually loaning money. So when you buy a $100,000 bond, you've actually loaned money to the company. And as you mentioned as well, kind of a sub-piece of fixed income is high yield, or no one ever calls them junk bonds anymore, but everybody wants to call them high yield. So you have a high yield bonds. But the point is, as I mentioned earlier, you want investments that zig when others are zagging. So typically, stocks and bonds don't behave the same, meaning sometimes they're up, sometimes they're down. So you want a combination of stocks and bonds to smooth out the volatility. Now, it gets a little tricky because high yield bonds are junk bonds, and they don't behave like bonds. So you might see, well, your financial advisor, you come in, well, you might want these high yield bonds because these are paying 6 or 7%, and investment grade bonds are only paying 5. Well, of course, everybody wants those 2 extra points, but you got to look and see, well, how does that fit into this portfolio of you wanting things that zig and zag? So you want to take the high yield bonds and kind of treat those like stocks, because as we're going to show in more detail later, high yield bonds behave a lot like stocks, and they don't give you that foundation of your portfolio. So it's good to remember, equity is ownership, bonds are loans, and high yield bonds don't behave like bonds, they behave like stocks. So that's kind of your first step in making sure that you've got everything spread out. Good rule of thumb is typically your age minus 100 should be in stocks. So if you're 60 or 70 and near in retirement, it's a good starting place to say, if I'm 60, I should have about 40% of my portfolio in stocks. And obviously everybody's different, but that's a good starting place to know how to build your portfolio. The closer you get to retirement, the more you should have in fixed income, investment grade fixed income.
Okay. Carrying on and talking about that, our next slide deals with equities and market capitalization. You briefly touched on large cap, mid cap, small cap, and what that means. Can you expand a little bit more on that?
This is real straightforward. Equities in the different capitalization structures. Small are the really small companies that have, and capitalization just means when we issue our stock, how much is our stock worth? So, I mean, take for instance, General Motors. General Motors is going to be worth billions of dollars. That's a large cap stock. Now, some little tiny startup, might be a pharmaceutical company, an internet company that just started, just went public, that's going to be a small cap. Now, traditionally, the smaller the company, the more volatility you have. So as you get nearer retirement, you want less and less small cap. But as we're going to go through here in a little bit, and as I mentioned earlier, each one of those, small, mid, and large, all behave randomly, differently. And so it's important to have each one of those pieces. You asked me earlier, Erica, about diversification, and having your equities or stocks split up between small, mid, and large is just as important as spreading out between industry sectors. And the same is true below with style. Having value, growth, and core, as you see here on the bottom, value and growth, you need to have some value and some growth because they don't behave the same either. So it's very important in this diversification process to make sure you have small, mid, and large, and also to ensure that you have value, core, and growth, because we're going to walk you through and show you over the last 10 or 15 years how drastically the performance of each one of those have been different. So it's important to be all spread out amongst all of them.
And for viewers that may not have a financial advisor, how can they ensure that they have adequate asset allocation, large cap, mid cap, small cap, or value, core, growth in terms of the equity styles? What kind of independent research can they do, or what would you recommend?
Well, it depends, and that's a good question, and we'll maybe break it down to people who do have financial advisors and those who don't. Obviously, it's a lot more challenging if you don't have a financial advisor, but Morningstar has some software. Let's say you own mutual funds, and you can type the names of the mutual funds into Morningstar, and they'll help break it out for you. So you can see they have what they call a style box, and it has it broken out between small, mid, and large, and then your investments are also broken out between value, core, and growth. So you can do it that way, but it's much harder if you don't have an investment advisor to figure that out. I think most people anymore use a financial advisor, whether it would be the Merrill Lynch's or the Citigroups or whoever. And I think it's important to go in and in a matter of an hour, your financial advisor should be able to explain to you that you have all those different parts of the style box, and you have small, mid, and large, and value and growth, and show you what your asset allocation is. And I think that's real important because most people think it's stock picking, it's stock selection. As we're going to get into in a minute, the academic and the industry studies all show it's not about stock selection, it's about asset allocation and diversification.
Right. And when you go into one of these institutions and seek financial planning advice, I know one of the things they're going to ask you about are your investment objectives. which is what our next slide is about. And I think it's important for the viewers to know really what those terms mean if you say you have an investment objective of growth or income or income and growth. Can we start with growth and what that means when they check that box and say that that's what their objective is?
Unfortunately, when you open up a brokerage account, there's all kinds of different boxes to check and questionnaires to fill out. It's very important that you get a copy of those materials, because if you ever do have a problem, and hopefully you won't, but if you do, and you do lose more than you should have in the stock market, growth and income are terms of art in the industry, and growth means stocks typically. But in normal parlance, if you ask somebody out the street, do you want your portfolio to grow? Of course you do. I mean, that's the answer. Of course you want you to grow. So growth in the securities industry, term of art, means stocks. Income means bonds, and balanced between stocks and bonds can mean balanced or core. And most people, no matter if you're in your 40s, you're in your 30s, you still want some fixed income to help smooth out volatility. So growth means stocks, income means bonds, balance means a combination of the two. The million-dollar question, obviously, is where on the spectrum between growth and income, because stocks and bonds.
They go to volatility and what kind of risk you're willing to take.
That's exactly right. So what you're looking for is the combination of stocks, bonds, and cash, because as we're going to go through a couple charts here, that'll show you how to smooth out the volatility by adding all those asset classes together.
So let's look at this next slide, which is a pie chart that shows what a portfolio may look like. Can you explain how this chart is broken down by percentage in terms of asset allocation?
Sure, and if we could zoom in on this chart so that you can see this. This chart, it's called the Bauer study, and it has been used across the industry in academic circles, and it's been updated, but all the results are almost the same. Over 93% of a portfolio's performance is attributable to asset allocation. So this huge part of the pie chart here, the powder blue part, is asset allocation. That's the factor that contributes to portfolio performance. So what's surprising about that is most people would pick stock and bond selection, meaning, hey, I need a stockbroker to help pick my stocks. That's what I hire my stockbroker for. And they're going to call me and tell me when to buy and when to get out, and you should buy Ford, or you should sell Ford, or you should buy IBM. And the truth is that's really not the way it works. In the academic studies show that buy and hold strategies that are well diversified and spread out between all the different asset classes, the stocks, bonds, and cash, style box, large, mid, and small, are how 93% of a portfolio is driven by that asset allocation and diversification, not market timing and not stock selection. And quite frankly, I think the securities industry sold a bill of goods to most retail investors that think making money in the stock market is about stock selection and getting in and out at perfect times. And the studies show that it's unequivocally a falsehood. The point is to stay in the stock market and have a well-diversified, well-allocated portfolio, because that's where your returns are driven over the long term.
Now, talking about a well-diversified portfolio, I think that is a fundamental investment concept that we should explain a little further. Can you talk more about diversification between cash, bonds, stocks, as reflected in our pie chart there?
When you go into a brokerage firm and you sit down, kind of like this, across the table, and most folks, I don't care, you can be very, very sophisticated and do whatever you do, whether it be a doctor, a lawyer, whether it's somebody that works at one of the oil refineries in the defense industry, very good at what you do, but you don't necessarily have a strong foothold in this area. So one of the things to do is that the brokerage firms, especially the large ones, have asset allocation models. So let's go back to Citigroup. They'll have recommended models. So if you're 55, 60 years old, and it's called your time horizon, how much time before you retire, 55, 60, I got 5 years, 10 years before retirement, and I need 4% out of my portfolio when I'm in retirement, there'll be a model asset allocation guideline that's already put together. And no disrespect to the folks here in Pensacola, but you don't got to rely on some guy from Pensacola that's been doing this for 2 years to put it together for you. There's already the up in New York and the bigger cities filled with very smart graduate level finance folks that help put those models. And I think we have kind of a sample of one here behind me in the pie chart put together. And you can use that as a starting place to help put together your portfolio. And almost every large broker-dealer has one, and it's a great piece. Get your account opening docs with the questionnaires, get copies of those, and then also get these asset allocation models to help steer you in making your decisions about how much stock, how much bonds, and how much cash to have.
And as reflected on this chart, on this slide, diversification is of the utmost importance and the opposite of what you would call concentration,
right,
which is another term that you may hear in looking at your investment options.
That's exactly right, and that's a good point. The concentration can be in individual stocks. You can be concentrated in just 1 or 2 stocks, or your portfolio. If you have 90% stocks, 10% fixed income, and you're 60 years old, facing retirement, you are concentrated in stocks. So concentrated is the absence of being all spread out across all the different sectors.
Now, keeping it on this train of thought, can you explain this next chart called the efficient frontier and standard deviation risk? This may sound foreign to a lot of our viewers, and it's something that I think that we should make people aware of.
Yes, and if we could zoom in on this too. And standard deviation sounds real fancy and very complicated, but standard deviation is on this bottom axis, and all it really is just a measure of volatility. So the further you go out across this axis, the more, the bottom axis here, the more volatile. So this is the more ups and downs the further you get over in this area. On the left-hand side is the returns. So the best place to be on this chart is in this quadrant, your top quadrant right here on the top or left-hand side. And here's the reason why. This makes the point about asset allocation. It's called modern portfolio theory or efficient frontier. So this is 100% bonds, and this is 100% stocks. 100% bonds, you can actually have a higher return. Remember, this is risk or standard deviation here. So you can actually have higher returns with less risk by adding stocks and bonds together. It's that zig and zag we talked about earlier. So as you can see in this portfolio, 20% stocks and 80% bonds has a higher return than 100% bonds, but less risk because it's further back this way. If you add 40% stocks and 60% bonds, you have higher returns with less volatility than all bonds. So as you go all the way out, the more stocks you add across this quadrant, the higher return, but the higher volatility. But this is your sweet spot back here. This is what they call the efficient frontier, where you're picking your stocks and bonds to reduce volatility without sacrificing return. This chart gets a little confusing, and I put it on just for one point. And if you can see, it's difficult to see because it's a little bit black, but it's the same efficient frontier we just looked at.
Right.
And this is 100% stocks up here, and the point is, this is a concentrated stock position. Remember, it was 100% stocks on the last chart, and this is risk that you're taking on that's concentrated risk, and it's uncompensated, meaning you, by diversifying and spreading out between asset allocation, stocks, and bonds, you can reduce the risk and increase the return, and that concentrated stock position is where you lose money unnecessarily. So when folks bring their portfolios into us, we have a team of analysts that will break apart these portfolios, and we can actually walk you through on your portfolio how and if you would have performed had it been invested correctly. Because keep in mind, the financial industry has a duty or an obligation to put this portfolio together to meet your needs, to meet your retirement needs, and it's got to be what they call suitable. So that's where they have an obligation. It's not a matter of if you lost money, it's was the portfolio constructed appropriately to meet your investment needs.
And what can an individual do prior to a litigation ensuing to ensure that their portfolio is being well managed? Are there tools out there that they can educate themselves?
That's a great question. And actually, yes, you can use benchmarks or compare your portfolio against benchmarks. And be careful that it is not an all-stock benchmark. You can customize benchmarks where you take 50% stock, that's over all different kinds of industry sectors, and 50% bonds, and compare how you're doing. And if use that rule of thumb, if you're 70, then use that 70-30 mix and compare it to how you're doing. That's probably the easiest way to do it.
And you touched on diversification across sectors, which is very important, and the topic of our next slide. Can you talk a little bit more about how you diversify across sectors and what that means?
And that, again, just means spreading out against all, like healthcare, gas, petroleum, tech, whatever. It's all spread out amongst industry sectors. And we only have like another minute or two. If you wouldn't mind jumping to the next, I think it might be, we'll keep going two more in. This one right here. This is exactly your spreading out. And we only have about a minute left, but let me see what I can do here. This is 1995 to 2010. And what's fascinating about this is this blue line here is the dotted one is large caps. So this would be a large cap stock portfolio in these blue lines here. The red dotted line is the Russell 2000. That's small cap stocks. So large by blue and red up here. And they also are value and growth. The difference is over 13 years, large cap growth is only up by 70%. The same period of time, small cap value is up by 300. So it just demonstrates the importance of spreading this all out amongst different asset classes and industry sectors. So I think that's our segment for tonight, and thank you for joining us, and we appreciate the opportunity.
Tune in soon.